As the markets continue to fall this week, I've been taking advantage of this opportunity to load up on some investments that are now offering much higher yields than they were just a couple of months ago. In this video, I'm going to share a handful of the high-yielding investments that I've been buying over the past couple of weeks. My reasoning for buying more of these holdings is because I think all of them are still in a good position and they're now selling at a much more attractive price. I'll also touch on some of the risks involved with each of these holdings as well. As always, if you're considering any of these positions for yourself, then be sure to do your own research and come to your own conclusion to make sure that they align with whatever investing strategy that you're pursuing in your portfolio. So with that being said, let's get into it. The first stock that I've been buying more of over the past few weeks is Hercules Capital, ticker HTGC. It's a business development company that specializes in lending money to companies in the science, technology, and also renewable energy businesses. Unlike a lot of their peers that operate within this same category of BDCs, Hercules has continued to post really strong numbers over the years, and they're still in a really good position today. I covered their stock in this company a little over a month ago, in which I talked about how their share price had tanked pretty massively on two pieces of news. The first was the news regarding the tariff situation, which at the time was just getting started. But roughly at the same time, Hercules had also announced an offering for their company. On March 5th, they had announced that they had agreed to sell to the initial purchasers in a private offering $250 million aggregate principal amount of its 4.75% convertible unsecured notes that are due in 2028. Offerings like this often cause the share price of a stock to go down because shareholders will now own a smaller percentage of the overall company. You can see HTGC has fallen pretty dramatically in share price this year, being down a little over 14.5%. Yet all the while, this company is still posting really good results as of their most recent quarter. According to this press release, their full year 2024 NII grew by 7.1% year over year, and they reported a good amount of new fundings, $1.81 billion worth last year. As of their last quarter, they earned 49 cents in net investment income and have a base dividend at 40 cents per share. This translates into their base dividend being 123% covered, which is likely one of the best in the BDC sector right now. They've also continued to pay a special dividend every quarter for almost the past 5 years. Overall, they've been one of the best performing business development companies in their whole sector, including among the science and technology focused BDCs. As of the making of this video, President Trump is talking a lot about wanting to drastically lower interest rates. That could serve as a risk for this company if Trump does get his way and we do see rates drastically fall. But I think it's unlikely given just how hard it would be to replace everyone who helps make that decision. But as of right now, the high dividend coverage still makes this company pretty appealing to me. A second holding that I've been buying more of is my preferred ETF, which is the Virtus InfraCap US Preferred Stock ETF, ticker PFFA. Over the past 3 weeks or so, I've bought an additional 48 shares of this ETF, and I continue to get a better discount and a higher yield as the markets fall. Right now, this ETF is currently offering a yield of well over 10%, which is a great deal considering the investments that it holds. PFFA is a diversified fund that only holds preferred stocks, which are considered safer than common stocks. In terms of dividend priority, if a company wants to pay a dividend to common shareholders, they first have to make sure that they pay their preferred shareholders their dividends first. They're also higher in terms of priority if a company goes bankrupt. If there's anything left after a company liquidates their assets from a bankruptcy, then preferred shareholders are more likely to receive some sort of their investment returns back as opposed to common shareholders. But although PFFA holds safer investments, that doesn't mean this ETF doesn't come with any risk at all. The high yield that's offered by this fund doesn't just come from preferred stocks, which typically yield between 6 and 8% on average. But Virtus will pool these investments together, and in order to boost its yield up to where it's at, will use a moderate amount of leverage on them. So on one hand, anytime you use leverage, you're going to be adding risk. Leverage multiplies gains, but it can also multiply losses. But on the other hand, PFFA uses leverage on a safer investment type. So you can see how things kind of balance out here with this fund. I've also never touched on another really positive thing about PFFA, which has to do with this fund's chief investment officer. Jay Hatfield, who's listed as one of the fund's portfolio managers and is also the CEO of Infrastructure Capital Advisors, the fund's sub-advisor, has a large amount of his own personal wealth invested in PFFA. During interviews, Jay has said that he's invested well over $1 million worth of his own money into this ETF. That's obviously a pretty good sign of confidence whenever someone closely associated with a fund buys it with their own money. It's similar to the insider ownership percentage of a stock, which I like to talk about with some holdings. When it's high, it's usually a good sign of confidence that those most familiar with the business are optimistic about its future. If you're not a fan of leverage, then there are other preferred ETFs that exist, like PFF, that don't utilize it. But of course, the yields will be much lower in every case, and they all pay an inconsistent dividend from month to month or quarter to quarter. This next holding that I've been buying more of is one that I don't normally talk about too much. It's another newer holding in my portfolio that I just started buying last year to gain more international exposure. That holding is the Amplify CWP International Enhanced Dividend Income ETF, ticker IDVO. According to its fact sheet, IDVO is designed to offer monthly income while providing high risk-adjusted returns through high-quality international companies. IDVO seeks to provide gross annual income of approximately 3 to 4% from dividend income and 2 to 4% from option premium. On its website, it describes how this ETF seeks to provide income from international dividend-paying stocks and by opportunistically writing covered calls on those stocks. The dividend and option income reduce the price volatility versus the overall market during times of broad-based market declines. Normally, this ETF doesn't offer that exciting of a yield. It does pay monthly dividends, but because this fund also prioritizes long-term share price appreciation, its yield isn't as high as the others that we've looked at today. Normally, IDVO yields between 5 and 6%, but given how the markets are down right now, it's made everything, including IDVO, much more appealing. You might have heard that international stocks have largely been doing pretty good this year when compared to US stocks, which is true. IDVO is actually up for the year in terms of share price, but its share price is down over 7% in just the last month. It's really these lower yielding investments that provide growth that are offering some of the best opportunities in the market right now, because their yields are much higher than average and they provide that growth that you don't get with closed-end funds and a lot of the other ultra-high yielding investments. Looking at IDVO's dividend history, you can see very consistent dividend growth over the years. Since being launched, they've increased their distributions every year, going from 12 cents a month in late 2022 to a little over 16 cents a month less than 3 years later. The kinds of stocks that this ETF invests in, though, are limited to ADRs. And although the diversification isn't that great in terms of the number of holdings that they have, they are pretty spread out across many different sectors. But ever since I started investing in it, I've been pretty pleased overall with its results, and I've been working on growing up my position in this ETF. But that's going to wrap up our look at some of the holdings that I've been buying more shares of during this down market. Let me know your thoughts in the comments and if you hold any of these investments, or if you have other holdings that you're pretty confident in, then feel free to share them below. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.